are we in a recession now? Or is the alternative, are we preparing for a soft landing?
Well, I think we're probably not in a recession.
Good evening, everyone. I am Jim McCarthy, the Chief Operating Officer here at Avid Realty Partners. We are excited tonight. We are covering the topic of inflation, CPI, PPI reports today. And as we've always said, we put out content when it's relevant. Also on the call tonight, we have the CEO and founder, Craig Berger.
Hey, Jim. Hey,
Hey,
everyone.
Craig. So we're excited. We have, throughout the firm, come up with a number of questions that we think are pertinent to today's events. And then it's, how is this going to impact the market and the things that we're doing and how it affects you in not only the remainder of this year, but certainly 2024. And so with that, I think it's probably good to start with the big picture. And of course, the topic that everyone's talking about is inflation. So, Craig, if you wouldn't mind starting off with your take on inflation, PPI, CPI, what's going on right now?
Sure. Thanks, Jim. Appreciate it. So, big picture inflation has come down quite meaningfully from year ago levels where it was officially peaking at 9%, but I think we all realize the real inflation number was more like 15 to 20%. Anyone who went out and bought anything last year or 2 years ago sure feels like it was 15 to 20%. The official number was 9%. Now inflation's around 4%, high threes to 4%. So it's come down quite a bit, but it's not a straight line down. It's a two steps forward, one step backward type of proposition. Within the last week, we've gotten worse than expected readings in PPI, Producer Price Index, and CPI. Although CPI, excluding food and energy, was a little more in line with expectations. But I'm not sure why anyone would want to exclude food and energy since we all eat and drive cars for the most part. So it's not coming down as quickly as the Fed maybe had hoped. And while the Fed has taken aggressive actions, raising the federal funds rate to 525 to 550, some of those impacts are still rolling in. And so rates, we've gone through this higher for longer discussion, and that is kind of where we're at. So making progress, but not enough progress. And frankly, the Fed's target of 2% inflation seems like it's going to be difficult to achieve anytime soon.
So, with that being said, 2024, I mean, by the definition, are we in a recession now? Or is the alternative, are we preparing for a soft landing?
Well, I think we're probably not in a recession. We're probably in a soft landing. We might be in a very modest dip, but we had a really high high during COVID. And that high was amplified by a lot of free money from the federal government, multiple stimulus checks, a bunch of stimulus that we didn't need. It was amplified by the Federal Reserve and their Frankenstein baby known as quantitative easing, and putting all of that free money out to Goldman and Morgan Stanley and Citigroup. We know how much those folks need free money. In fact, it's better than free. They got 0% interest money when inflation was 15 to 20%. So, they're being paid 15 to 20% real dollars to take that money. Some could argue. So we had a really high, and now we're in the post high hangover. I wouldn't call it a recession. Some people call it a rich session, but we're probably in a soft landing. The jobs picture is still quite strong, and jobs growth and job openings have been stronger than expected for the last few months, including the just reported September jobs numbers and the upwardly revised August job numbers. So people are still hiring. They still remember that they couldn't get enough decent people to work their open jobs, and they're hiring aggressively. Rents are still going up quite a bit, and that's one of the contributors to inflation. Wages and energy. Energy has gone up a lot for various reasons, some obvious, some less obvious. And that is, causing this inflation number to stick around 4%, and is, leading me to think we're not in a recession, we're in a soft landing kind of limbo zone.
So you mentioned the 4%, and earlier you'd referred to the 2%. Is that the right number, for our inflation target? Or, in your opinion, as we look back, if we achieve 2%, do we look back on this wake of destruction that we've brought down jobs, we've brought down inflation, we're at 2%, but what has it done to us?
You're spot on. That was a great question. The Fed's inflation target used to be 3%, not 2%. It's only become 2% since we've had this inflation debacle caused by the Fed itself. And so, I don't think 2% is the right number. I think 3% is the right number. And we're pretty close to it. And I think it's going to take, some additional months of post-COVID, post-high normalization in order to really achieve 3%. And so I don't think the damage and destruction, I think, we're in a credit cycle and a credit contraction, and somewhat of a financial instruments contraction. We're not really in a widespread fundamental everyday Joe recession. It is soft, but it's really a credit and financial driven contraction because of the Fed's move with interest rates. So I don't think getting to 2% would be worth the widespread destruction and damage to ordinary Americans' jobs and their financial picture. So I think 3% is probably the right target.
Interesting. So as we talk about cuts, when do you see cuts happening? Is it next year? Is it the year after? And I guess I'd say, what are the futures telling you about that?
Well, interest rate cuts, great topic. But before we get into that, since you didn't specify, you just mentioned cuts. I think what we need to see and what we're not seeing is federal government spending cuts and deeper cuts to the Federal Reserve's balance sheet through quantitative tightening and the roll off and expiration of bonds that they're holding, where they don't replace those bonds. So those are the cuts that are most important to the future viability of America, so that our kids and grandkids can enjoy this great country and have the dollar still be strong, hopefully the world's reserve currency. But we need cuts to all the wasteful things at the federal and state and even local government levels, unfunded pensions, the crazy healthcare costs. We need to rationalize healthcare. I'm not saying cut healthcare, but how do we do it more efficiently? How do we cut out fraud? How do we stop giving away so much crazy free money? The size of the federal government, it's just very unwieldy. Random factoid, but total federal debt to GDP was 30% in 1980, and today it's 130%. Debt has quadrupled as a portion of our overall economy, federal debt, and that's scary. So really, we need to tame that beast, or we're going to be spending a huge portion of federal expenditures on interest, even more than we're spending today. You mentioned interest rate cuts, and I do think we're going to see cuts in 24. I don't think Uncle Sam can afford to pay 4.8%, 5% on its treasuries when total debt to GDP is now 130%. I just don't think Uncle Sam can afford those very large expenditures. In fact, interest is now more than defense spending. I'd much rather be spending our money on defense spending than than on interest and funding past wastefulness and present wastefulness. So I do think we see cuts. We have a presidential election coming in November. I would guess by July, we're likely to see the first cut. It could be sooner. The CME Fed futures watch, or the interest rate futures market, is baking in something like a 15% chance of a cut in March, and that grows to something like a 50% chance of a first cut by July. So I do think it's coming. I do think that'll provide some relief. But the challenges that we have today are still going to be there.
Excellent, thank you. And it's probably, as you mentioned, defense spending, a good place to stop and then start our conversation on some of the geopolitics that are happening right now. It's hard to talk in the same conversation as both, but history tells us that war is an inflationary event. How much more challenging did the Fed's job get in the last 5 days, and then obviously in the last 6 months?
So I do think war is inflationary. I don't know that the US is in a direct war. We're in multiple proxy wars at this point, right? The US is in a proxy war against Russia and the Ukraine. The US seems to be potentially entering a proxy war against Iran in Israel and the Middle East, and that stuff is scary. Obviously, we're sending all of our love and best wishes to everyone in Israel and anyone affected by those cowardly terrorist actions. The Fed's job, I don't certainly, if you're measuring the Fed's job by inflation, I think the Fed's job is difficult already. If the US ramps up production of weapons, of ammunition, which by all accounts is running low, and whatnot, then the Fed's job definitely gets harder from that perspective. But also, I think, look, when you're at war, when you're really at war, fighting for your survival, obviously your priorities change, and a silly thing like a 2% inflation target is meaningless when you're talking about survival of yourself, your family, and loved ones, or survival of your country, or fighting for freedom, or your safety, or the people that you love, their safety. I mean, what's an inflation target relative to those priorities? And so to some degree, all of our priorities change if we go to war.
Yeah, absolutely. And our thoughts do go out. So you spoke about the SPR in the last inflation piece. Are you concerned about the recent conflict in Israel could bring and strain on the energy markets? A little different turn on the same topic.
Yeah, I mean, look, the world still runs on oil, and no matter how much the Squad and AOC want the world to run entirely on solar or other clean energy, that's just not a reality today. We need oil, we need to drill, we need shale in the US, we need to ramp back up our production of oil so that we're not dependent upon those who fund terrorism for our economy to run. Um, and so, I think backing off the pipeline, backing off shale production has been a strategic error by the Biden administration. The draining of the Strategic Petroleum Reserve, when that happened, I think in early 22, was another error, right? Obviously, Joe Biden was trying to ease people's pain at the pump, regular working class people, and there's some good intentions there. But that Strategic Petroleum Reserve is strategic for a reason, and that's in case anything really happens and goes south, we need that energy. The fact that it's at about 50% of where it was 18 months ago is a problem. And now we're going to be refilling that SPR at higher levels and rewarding Russia, Iran, and other vendors of oil at a time when we don't want to reward them. We shouldn't be rewarding Russia, even if we're not buying oil directly from Russia. When the price goes up and they sell to India, they sell to others, that benefits them. So, I think we need to be strategic and smart about how the U.S. deploys its resources, and the SPR is definitely one of them. And I don't like to play politics with the SPR, and I don't think our leaders should either.
Excellent. Great answer. So let's talk a little bit about apartments. Why don't you give us your oversight on what's happening in the apartment market right now?
Okay. The apartment market is, I think, a great buying opportunity right now. Prices have come down, I'd say 15 to 35%, with maybe a median price reduction around 25%. So, this is what buying low feels like. It's never comfortable. It's never pleasant or easy. But I think down the road, 3 to 5 years from now, when the world normalizes, when this interest rate cycle and post-COVID inflation cycle normalizes, that buying at today's prices will look smart in retrospect. Sellers are grappling with whether they want to sell at current prices. Other sellers have to sell at current prices because they have bridge loans that are expiring, or because they have construction finance that is expiring, or because they have portfolio level cash requirements and stress and need to raise cash. And so there's a bunch of reasons why there are some market sellers out there today. But sellers are definitely grappling with selling at lower prices. From a buyer perspective, companies that have cash on the balance sheet are in a great position right now. And those folks that have to raise capital are in a very tough position right now. It's very difficult and challenging to get equity. And the folks that are really putting out a lot of equity are the preferred equity, pref equity players. Seems like everybody today is a pref equity player. And that makes putting together the entire capital stack really challenging. So that's a little bit of the big picture, from an operations, from just a big picture apartment business perspective.
So you mentioned a little bit about prep, and everyone does seem to be doing prep, and we've talked about that quite a bit in the past. But so what else are investors telling you in terms of either sitting on the sideline or waiting? What are you hearing in terms of that as a response to deals that we think are 40% discounted?
25%, but yeah, give or take. There's a lot of bridge debt coming due in 24, 3-year bridge loans that were placed in 21 at high prices. And a lot of investors think that things are going to get worse. Pricing is going to get worse. The opportunities are going to get better over the next 6 to 12 months. So a lot of folks are saying, I don't want to risk my job or risk my career trying to catch a falling knife. I'd rather just wait on the sidelines until I know prices have stopped going down. And once they've started going up again, then we can get in at that point, and it's less risky for me, professionally or personally. So we're hearing a lot of that. Other folks that are putting out pref are saying, hey, we're getting 14-15% pref, and if we use leverage on our own money, then we're getting 20% levered returns on our pref dollars. And why be common if you can get 20% levered returns on your pref money higher up in the capital stack, protected? And I understand their perspective, right? I get that. I also think there's a lot of pref players that want to put out more money than they are, and are not putting out money because it's such a competitive environment to place pref equity.
So let's talk Avid Realty Partners. What are some of the key challenges we're seeing? What are some of the key opportunities we're seeing?
Well, I think overall, we spoke about sort of buying apartments, the challenges, and sort of the big picture. We didn't really talk about apartment market fundamentals. So let me just run through that. It obviously depends on whether you own Class A apartments or Class C apartments, what geographies, what markets you own in, and so on. So it's not like there's one answer to what's going on at the property level, at the operations level. But what we're seeing is that rent levels overall are stable to still slightly increasing. In some markets, they're falling. Some markets that rose at meteoric rates, places like Austin, Tampa, Phoenix, and Vegas, are the markets that are seeing rental rates correct the most. But the correction might be 2%, 3% off of peak levels. There is a lot of apartment supply out there. It's been a big new construction delivery year in 22 and 23 and into 24. And so those apartments are coming out and need to be absorbed, rented, absorption. And so that new supply is pressuring occupancy, and it's pressuring rates, in those same meteoric markets that I mentioned. And so we're digesting new supply. Occupancy is lower than it was. Rental rates are stable to slightly higher, in some great markets, slightly lower. We've seen a lot of challenges with tenants not paying rent in our B and C class deals. A lot of fraud, a lot of bad debt, non-collection challenges. And obviously, we're seeing big expense increases due to inflation across payroll and maintenance. Obviously, insurance is another huge item that's gotten meaningfully more expensive. And on the property tax side, a lot of these municipalities are still jamming property taxes higher and trying to feast while they can. And you know, in certain places like Texas, it's just downright greed. In some cases, we could never sell our apartment properties for the prices today that we're being assessed at. And so we are doing hand-to-hand combat against the appraisal districts in order to get our property tax bills reduced on appeal. And so, you know, overall fundamentals are strong. I count our team's blessings that we're not in the office sector, or that we're not in the hotel sector, where financing hotels is next to impossible right now, and that we're in a very stable multifamily apartment market.
All right, so give me your outlook. Apartment market, Avid Realty Partners, what's the next 6 to 12 months look like?
Well, for us, we're looking for deals, and we're looking for the right partners to do those deals. Some of our partners are on the sidelines. Some of our partners are active. A lot are not active. Some are pref. Some are not pref. But you know, we're looking for asymmetric risk reward deals and looking for the capital to go with those deals hand in hand. Smaller deals do seem more achievable right now, right? Raising 10 or 12 million of equity through friends and family, and some of that maybe paired with pref, maybe not, seems like a feasible way to get deals done in this environment, rather than searching for an LP equity investor to write, you know, 25 million of a $30 million equity check. But equity checks are high, leverage is down. So look, we're out focused on two things. One, looking for asymmetric risk reward deals so that we can deliver for our investors down the road. And B, making our portfolio that we have now perform in the midst of some of these market challenges, the tenant no pay issue, lower occupancy, you know, residents stretched financially. And so we're really focused on improving the capabilities of our internal team from an asset management perspective and a property management perspective, so that we can come out of this soft landing, post-COVID downturn, recession, whatever it is that we're in, so we can come out of this credit cycle, interest rate cycle, stronger on the other side, and hopefully bigger and with enhanced corporate capabilities.
Excellent. Before I let you give your closing statements, I just want to thank everyone for joining. It's no coincidence. We really do try to time these where it's topical and that it's informative at the same time. And I think today was a great day to come back on and address everything, inflation, geopolitical, and then the apartment industry and how that affects you. So as always, we appreciate everything you do. With that, Craig, why don't you say goodnight for us?
Everyone, thanks for joining. Really appreciate it. There is a lot of uncertainty out there, but that uncertainty is creating opportunities. If anyone wants to reach out, Craig at avidrealtypartners.com. You can find me on LinkedIn as well, or through our website. There's some great opportunities out there, and I really look forward to meeting you, speaking with you, and having a great year